Our next presentation will be Collin West. Collin, for over two decades, Collin's been consulted with the financial advisors and plan sponsors to provide retirement and benefit solutions to their participants. He currently leads a team of retirement directors working with advisors in the western half of the United States, focusing on understanding clients' complex needs in order to provide tailored benefits such as 401k, defined benefits, health savings accounts, student debt, workplace giving, and payroll solutions. Collin, welcome. The floor is yours.
Thank you, Will. Thanks, Definiti. Appreciate you having me. I know you haven't had Fidelity in your mix so far, so we're excited to be a part of this. What I was hoping to do for these next 20 minutes is to do two things. First is to just quickly preview our new offering that's available with Definiti and our TPA Council members, which is called Fidelity Retirement Edge. Just take 2 or 3 minutes on that, and then the remainder of the time, provide you some valuable insight from Fidelity's latest plan sponsor attitude survey, which you may or may not have seen in the past, but there's some really exciting information to share there for you as advisors. So let's jump in. Fidelity Retirement Edge is very exciting for us simply because this is a advisor and TPA sold offering for the small plan space. So those plans that are $1 to $7 million. And it's something that we've really built exclusively for launch with our council members like Definiti. So it's not something you can get anywhere right now. We've just launched it about 2 weeks ago, and we are providing some great efficiencies in terms of pricing. And I'll share that good news in just a second. So a $1 to $7 million space, and must have advisor and TPA involved from day one. And it's the same platform that Fidelity provides to our $1 billion clients. So, we are providing, state-of-the-art mobile app, website, operational excellence for all plan sizes. It's not like just a small market product. So we did something unique. We went to our service team and we said, what makes a plan run really efficiently? And let's build more of those. So in the small plan space, and I think, if there's anything you've kind of learned from what you've heard already today, the first thing is, what Julie Casey was talking about in terms of payroll and simplifying things. We want to have a 12/31 plan year end, one maximum loan. Yes, we can amortize and re-amortize loans. ACH loan repayments, you might not be familiar with that, but that's something we've been doing on thousands of loans. We get participants' bank account and they are paying us directly for their loans. So it's not flowing through the client's payroll, which clients like. As people come and go, they can continue to repay a loan. They don't get 1099s just because of a job change. E-certified hardship withdrawals. We track beneficiaries, required minimum distribution, and then we provide one annual complimentary fund amendment per year. What's out? Brokerage accounts, model portfolios, and if a client has company stock. So not the most common product requests. So we tried to simplify it there. And if that's important to somebody, they can still always use our flagship record keeping platform in that $1 to $7 million space. So that's not going away. We have great investment providers that are helping fund this offering. So really 19 world-class investment managers that I'm sure you're using today. We've got the zero rev clean shares, and we've got 12 B1s for those on the Zoom today that require commissions. 5,000 QSIPs, no proprietary fund requirements or stable value. So it's open arc. And one of the things that's really nice about this is we're providing that same Fidelity experience in the small market with the TPA like Definiti that can significantly reduce pricing anywhere from 15 to 30% off of our flagship product. So we would just need to know plan assets, number of participants, cash flow, and then how the plan will be moving, right? Because this is for takeovers only between $1 million and $7 million. And if it's mapping to target date funds, whose target date funds? If it's just a like-to-like mapping, send us the fund lineup. And obviously on the smaller end, we might have closer to that 30% reduction in our record keeping. If it's like a $1 or $2 million plan, closer to $6 million, it might be like a 15% discount. So simplified plan design considerations, efficiencies gained with Definiti, and you as the advisor And we have a dedicated team that is specific only to working with unbundled plans that will help service this offering. So there's a digitally guided onboarding that we all have access to, where we help the client set the plan up, and we can set it up a little more efficiently as well after we get that signed letter of intent. It goes live in about 60 days. So if you are looking for a proposal, haven't seen Fidelity yet or recently, reach out to your Fidelity salesperson and they'll help you run that. So that's Fidelity Retirement Edge. I just wanted to cover really briefly. We're really excited about our partnership with Definiti. We've been working really closely. My team asked me to give a shout out to Dave Casperson, Michael Albertsmeyer out west, but really talented sales folks, and they're well aware of Fidelity's offering. So that said, our remaining time, I'd like to just walk you through plan sponsor attitudes. And this is a survey each year where we are basically having a third party survey, in this case, 1,300 clients in all market segments that are responsible for hiring an advisor, responsible for hiring a record keeper, managing plan costs, choosing the investments. And so we get a really broad range amongst all record keepers, all plan sizes, of what plan sponsors are thinking and what they're thinking about advisors and really the industry as a whole. And so we try to come up with certain thematic kind of focal points. And you can see during fee disclosure or the fiduciary role, that oftentimes has become our theme for that year's survey. This is our 14th annual survey. This year, it's rising complexity creates opportunity for greater advisor impact. This survey has gotten picked up in all of our industry periodicals, gets some great publicity. Let's jump in. Here's the areas I'll cover really quickly. The relationship that you have with your sponsors, investment trends. Then we'll go into engaging participants, which is what Christy from T-Row was just talking eloquently about. And then sponsors focusing on holistic benefit programs. And then all that rolling into heightened expectations for record keepers. So let's start with some really good news. 94% of sponsors are working with an advisor. If you go back to our first iteration of this survey in 2008, that number was more like 20 to 25% were working without an advisor. So we've all done a good job sort of defining your value and really making clients see the benefit of working with an independent financial advisor. The other big note is 76% of sponsors were very satisfied or extremely satisfied with their advisor, which has been consistent the last couple of years. So what that means is there's a lot of areas that clients are really expecting you to help cover. And this is a theme for this year. They want improved participant outcomes. That's number one on the list. And then interestingly enough, how much time they spend on the plan, they want administrative support. So think what really Julie Casey just spoke about: APIs, electronic data transmission between payroll, ACH loans, which I just talked about, 316, which Definiti is a leader in. They're looking for those kind of help me run the plan kind of conversations. Also negotiations with a record keeper about fees, like be their advocate. I have a lot of thoughts about that. If you want me to bend your ear some other time, that's up 7% over the last year, as is a focus on index and passive investing. Participant education, just note this, down 6 points, second from the bottom. So those that are just doing, education meetings aren't cutting it anymore. There's heightened expectations here. And if you're not providing the right services, advisors might be in danger. Here's a great example. 37% of sponsors have changed advisors in the last 12 months. So we just heard clients are happy, but then there's a lot of change. And the reason why is because solicitations are up. People have really figured out post-COVID and really during COVID how to expand their geographic reach and market to areas they haven't marketed in before. And then clients seem to be finding something better that they didn't know existed. So they're happy until they realize somebody has something better in terms of knowledge, in terms of fiduciary status, in terms of better value add for the investment committee, for the participants, et cetera. 22% active advisor searches right now. And a lot of it, if you think about COVID, we had such a shift of employees, right? There's been a lot of people that were going from company to company, the Great Resignation. Same thing with committees. Committee members were moving as well. And whenever a committee turns over, you're seeing a lot of times a new advisor brought in based on a relationship. 29% of sponsors with a committee change are switching to a new advisor because they had a new relationship with a key executive. And I could regale you with all sorts of LinkedIn direct kind of messaging success stories. I'll just share one. An advisor with whom we work closely paid for the Wi-Fi on a flight recently and was perusing LinkedIn and saw one of their key clients had changed firms. And then by, just a quick exchange, the client said, yes, I'm at this new company. We really want you to come in here and help us change our plan. By the time the plane landed, the advisor had a signed new advisor of record form. So LinkedIn is real. Business gets done there, especially when you're tracking your contacts moving from firm to firm. So let's just talk about what's piquing a client's interest. And this is where you can, geographically see people upping their retirement game here from a prospecting perspective, where sponsors are getting more solicitations, and it's piquing their interest because advisors are more knowledgeable. There's fiduciary responsibility that they're taking off their shoulders, and advisors are talking about lowering costs. So if you're looking for some kind of ideas around prospecting, this gives you just ideas galore. Financial planning. This is what advisors are showing to clients that's really resonating. Planning, retirement income, financial wellness. Just talking about financial wellness with a client increases net promoter by 7%. There's sort of the tried and true classics of Social Security, budgeting, capital markets updates, but even fiduciary training. I've seen advisors provide an investment committee something called Anatomy of a DOL investigation or Anatomy of a IRS audit. And they'll pick a really well-known case in the news and walk through what the committee did and did not do well. Secure Act, we're getting a ton of interest here at Fidelity. Clients really are wanting to know, what do I have to do now? What do I need to know now? So that gives you sort of an idea of topics that sponsors want advisors to talk about. Let's talk about some investment trends because there's quite a bit here. And the main one that jumped out this year in the heavy way, second and third position, was the increase of collective investment trusts in retirement plans. As many of you likely know, firms have access to specialized share classes of CITs, oftentimes significantly lower cost than maybe a well-known fund that's already in a client's plan. And they're swapping out the fund, mutual fund, with a CIT. Not yet the case for tax exempt and 403Bs, but we're seeing this kind of big time. There's an interesting kind of couple of notes here too. We talked about investment kind of changes to index a minute ago. 22% began offering index funds for the first time. The actual number of sponsors that are offering both active and passive has been steady around 80%. And, retirement income and offering annuities in the plan is a big kind of step up. This year went up 4 points. Obviously, it's discussed a lot. We're not seeing a lot of flows in terms of retirement income, but there are tools, for example, on our website where people can take automated payments out. There's education about withdrawal strategies. There's quite a bit in terms of target date funds that have guaranteed income as a component within the target dates. There's a brokerage window where you can go out to annuity marketplace where the sponsor and the advisor have sort of screened a number of investment providers for insurance purposes and providing retirement income on a kind of fee negotiated rate to participants. So this is an area that's up for grabs. 80% of advisors have talked about retirement income. The last one I'll just talk about real quick, which is on the way down, which is ESG, down 5 points. Sort of a hot button topic here. I'll just say those that are interested in ESG, it's a 50-50 split. You have 50% of the companies that are kind of mission driven, think tax exempt. They want to have a good kind of ESG conversation around their 401k. Those are the companies, them when you see them. And then the flip side, the other half are companies that are looking for a specific ESG fund, maybe to offer to a certain segment of investors, like a thematic fund. So just wanting to be a good corporate steward, avoid the kind of Enron WorldCom. And obviously at Fidelity, we have ESG scores on all of our securities that we track. So let's talk about participant engagement for a moment. And this is quite exciting. If you think about COVID, and I mentioned earlier the Great Resignation, what first happened in COVID was that there was sort of a panic, and a lot of companies really reduced their match out of prudence. It was a really tight labor market. And now that we've sort of been fighting that battle for talent for a long time, the top 8 things you see here have to do with increasing the match, reintroducing the match, and increased comfort in auto enroll, changing the matching formula. Those are all the greatest hits. Shout out to Fred Reish down here, enrolling or re-enrolling the full plan in a target date. So that's refaulting, where you wash everybody through the QDIA. That's getting more popular as more record keepers are able to do that. Another notable one, just adding Roth. For those plans that don't have Roth still, that's part of Secure Act. So you're seeing some increase there. So maybe the next kind of big piece of news that I'll share that we've got really excited about is every year we ask our plan sponsor survey respondents, what's the most important benefit for attracting and retaining talent? And for the first time ever, it was 401k. Every other year, it's been health insurance. And I think it's a testament to everybody here for continuing to fight the good fight and do what we do. 401k is maybe not always the most glamorous, but to have 57% say it's the most, the top benefit for attracting and retaining talent is huge. I asked compliance if I could fly in a mission accomplished banner or spike a football. They said no. And the flip side to this, I'll just share, is unfortunately 401ks aren't just our clients' only priority, right? They wear a lot of hats. There's a lot that they have to do. And so this again creates some value for you when we talk about holistic benefit programs. First thing I'll start with, I'll cover a couple different topics as I check the time here. First one's HSA. This is something that I encourage everybody to proselytize, be the quarterback, talk about things that are related to the retirement plan. HSA conversations increase advisor satisfaction 7 points. So it's a great area. Clients are willing to pay for it. 91% are willing to pay for you to educate their employees on HSA. So triple tax-free, age 65, penalty-free withdrawals, just a huge benefit that people are realizing is like an easier bucket of retirement money. Second thing is individual work with participants. And I'll just simplify this slide. A lot of advisors are kind of skittish to do individual rollovers outside of the plan or even work with participants one-on-one. And if you look at how many are ambivalent or think it's perfectly acceptable for you to work with their employees outside the plan, it's 92%. And how many are actually working outside the plan? 65. So there's a disconnect there. More clients want you to help their employees outside. Those BIC exemptions and disclosures are worth it. Student debt, huge area of interest. 71% say that this is a big thing. Record keepers have been kind of owning the conversation here. 60% is where clients are usually hearing about it. We started our own student debt offering repayment program at Fidelity. We were losing talent in our call centers, and it's helped us just by offering this program to a certain subset of employees. It's reduced our turnover by 70%. And student debt repayments, I think everybody knows, restarted in October. We talk about credit card debt all the time, which is $1 trillion figure out there right now and increasing, but student debt is a $1.7 trillion albatross around our younger employees' necks that they're way more focused on than just their 401k plan. So it's really a huge benefit in the future. And if you want to learn more about our offering, we'd love to tell you how it works and how it's worked for us internally. Cybersecurity is another area, just to quickly touch on where our clients hearing about it. They're hearing about it in the news. That the biggest, most recent cyber breach that I think got publicity in our industry is the MoveIt data breach. It was a Russian cybercrime gang that we estimate will make between $75 to $100 million from selling personally identifiable information on the dark web for 54 million participants that they stole. It was a 0-day vulnerability, just meaning that before a particular firm could put a patch out there, the cyber criminals had already hacked in and pulled all the personally identifiable information, So There's a great DOL best practices, like a 5-pager on what sponsors need to know. You can have a cyber wellness audit, which we can provide. There's guarantees from various record keepers in terms of customer protection and ISO certifications. You can do a third-party RFP. There's a lot of ways for you to help in the advisor world to lead this conversation and really differentiate yourself. So you want to be that quarterback and be their first call on any of these topics. And so all of this kind of leads to growing expectations of the record keeper. And I'll just share kind of a big highlight here. The last 2 years, there's been a ton of interest in actively changing record keepers, 48% last year, 51% this year. Larger plans that are more complex tend to be less happy. Smaller plans tend to be happier, under 10 million. But the bigger plans are prospected more. So you're seeing kind of an average number of solicitations. Plans in the couple hundred million space are solicited 8 times a year, and only about 67% happy with a record keeper. Smaller plans sometimes don't know what they don't know, but 51% is obviously a lot of activity for companies like Fidelity. We've sold about 11 billion in the small plan space this year, 100 billion up market. We're really focused on doing things the right way and increasing our implementation capacity to deal with the additional demand. And some of it is just consolidation in our industry. There's been a lot of mergers and acquisitions, and clients have been shuffled around and maybe having some service challenges. So last thing, I'll just kind of end where I began, which is what's important to clients in terms of record keeper. It's a lot of the same things that's important to working with an advisor: administrative support, payroll integration, technology and websites, a big one, right? 88% demo logins. They say tech is everything. So if you're looking for a survey, go to Corporate Insights. They've got a ranking of all the main providers in terms of mobile app and website. But I encourage you just, moreover, to get comfortable being uncomfortable. There's a lot of value that clients are looking for out there. There's a lot of opportunity in terms of clients moving, advisors, record keepers. Have that conversation on HSA, student debt, individual retirement, working with people outside the plan, cyber. Lead those conversations. And if you're looking for more information on this Plan Sponsor Attitude Survey, or if you're looking for more about Fidelity's Retirement Edge with Definiti, please talk to your Fidelity record keeper contacts. We'd love to have a conversation with you. And again, we just appreciate you having Fidelity here. So thanks, Will. Thanks to Definiti.